philanthropos, welcome everybody to Economica, all about economics and finance. And thanks a lot to all new subscribers. That means a lot to me. And if you're new around here, please subscribe to Economica, which means about economics. And you will see that I will share with you for free. You will enjoy my bits of research. I'm a BSc students in economics and finance, and I will share with you my own research about macroeconomics and also the stock market. So you will find very interesting my content, and it's for free, so you can subscribe. So today we will see together what's going on in the labor market. Why, if you are concerned, why I'm not finding jobs, why still prices are so high, why there is this high cost of living, and why I'm sending my CV over and over and over again, hundreds of times, nobody's calling me back. What's going on with the employment market? I suggest you to watch my video. You can see the link in the video here about the ghost job postings. So all these websites which are supposed to upload vacancies of job offers, probably it's only a method to fill up the website, and behind there is no real job. So probably in 2026 the best way to find a job is to actually go to the physical shop and hand in your CV to the store manager, and probably you will be hired. So I strongly suggest anyone who's watching this video, go out and bring your CV in person, so that you will have a much higher chance to be hired by any business, and you will talk with the store manager, so there is more person-to-person contact, and it's way better than sending CV over the internet, and probably it's AI which is kicking you in the feet. So what has been happening in the job market? It's not very easy. Now we will get more into macroeconomics, which is my favorite subject. And for this time, I have been analyzing a lot of data as usual. Just yesterday, I've been working 12 hours without being paid by anyone. So 12 hours in front of a monitor doing modeling and changing coding, it's a very hard job. So what do we know up to now? So that the traditional, we have this marvelous thing which is the Phillips Curve. So the Phillips Curve is this marvelous concept, the marvelous equation, which tells us that for a certain behavior in the rate of unemployment, we will have a certain response in inflation, and vice versa. So the old school macroeconomic framework has always been, okay, we will have a healthy rate of a low rate of unemployment, so we will have more people in work, but at the same time we will have to tolerate a bit more of inflation, perhaps higher than 2% or structurally higher than 2%. And so that was that has been the trade-off that policymakers like the Federal Reserve or the Bank of England or Bank of Japan, I don't know, the central bank of the Banana Republic, that's mostly the trade-off that the monetary policy institution has always looked at. What is the spare capacity into the economy, how many people are unemployed, and what is our level of inflation. Then we have another component which is a lot typical of our fellow American friends, is that there is a huge component of inflation expectation. So once we get employed, we have a very nice salary of $100,000 per year. I don't know, I have no idea. But anyway, when we have a very nice job and we have a substantial wage, then what are our expectations? We build expectations how we want to build up our life. We want a flat in Manhattan, we want to have a nice car, we want to have our Starbucks coffee every morning, we want to have a takeaway at lunch. So all these kind of things, we build expectations in our way of life, in our lifestyles, in our I would call it somehow some vices. Sometimes we long for things which are not really necessary, but it's only just consuming. In any way, so we build expectation, and these are then become expectations, the famous or infamous thing, inflation expectations for policymakers. So how the central banks needs to take the consumer survey or the business survey, and they say, okay, tendentially prices are going to rise in 2, 3, 4 quarters down the line, because there is a build-up of inflation expectation. And this goes along with the business cycle. So when there is a healthy and robust economic cycle, so people are employed, they have good wages. So it's the case that inflation expectation, they tend to be above the 2% central bank price stability target. And that goes into the idea that we have a healthy labor market, but we are willing to tolerate a bit more of inflation. Another component that we have is that when there are inflation expectation, as you can all read here, inflation expectation are the dominant anchor. So when there is an anchoring and unmooring of inflation expectation, that depends also if there is some sort of slack or a spare capacity into the aggregate supply of the economy. That would be materials or a pool, a basket case of unemployed people. There is a spare capacity in the workforce. So there are people who are looking for work, and so they keep some sort of pressure on the job market. And so it depends of how we are going to implement our models, because what I have found, and what probably is the most I don't know if it's the most shared point of view in the macroeconomic research, but I'm the last of the person to say that. But what I have found is that the classic Phillips curve of the level of unemployment and the level of inflation, it does not really explain the dynamics into the economy, how prices are how prices level are formed, but there is already a component of the expectations of how prices will form in future. And we can have a very interesting discussion about what is consumer behavior and the different cultures. For example, if we take I'm sharing with you these slides, if we take the data, the macroeconomic data of the United States economy, we see a very clear structured economic framework. And so we see that there are higher inflation expectation, and that the consumer is a lot forward-looking. So when we utilize a slightly more sophisticated, but it's more complete Phillips curve, or a new Keynesian Phillips curve, or an hybrid Phillips curve, we are able to see that the component of forward-looking inflation expectation for the American consumer, it's way more weighted on the forward-looking expectation rather than backward-looking expectation. Now, for example, as you can may be guessing by my accent, I can tell you that perhaps inflation expectation of Italian consumer, they are way more backward-looking. So the Italian consumer or the average household, they do expect the level of prices to be stable on the basis of what were past prices, and that component it weights for something like 80%, while instead the American consumer, it weights more the forward-looking path. So inflation expectation, they do weight something like 0.6 or a 60% or more on what will be the expected level of prices in future. If we take, for example, the British consumer, we can see that the British consumer, it has some attitude of a 50-50. It's a 50% backward-looking, 50% forward-looking. But the attitude of the British consumer when we construct a theoretical general equilibrium model, we see that the British consumer is quite impatient. They don't value much tomorrow. They don't value much of postponing purchases or consumer habits, they don't value much £1 tomorrow rather than £1 today. So they are quite impatient. They have a beta component which is not very high. So what do we find in simple terms? We find that if we take a simple model, we see that the linear correlation between the unemployment gap and the CPI, it's a negative beta slope parameter, minus 0.19, which is traditional of the Phillips curve, but this parameter 0.19 is a very, very small parameter. It's very close to zero. So it means that the correlation between the gap in the unemployment, so what I was saying, this lack, if there are people looking for work, even though we have unemployment rate which is close to full employment of there and thereabouts, we see that this relation between the two, it's weak. So even though there is a positive or a negative unemployment gap, it does not fully explain why there are high prices or why there are high inflation expectations. So a case in time, which is not the United States economy, but it's sort of also the United States economy, but a common feature that we are observing generally in the global economy, we see that we have rising unemployment, so we are trying to find work. We send CV everywhere, but we have this issue, this feature of the cost of living or the persistency of inflation. And we, ordinary consumer or ordinary households, they continue to find that prices may increase marginally from period to period. So even though there is a clear perception or a clear evidence that economic activity is slowing somewhat, there is a sort of fatigue or there is less buoyancy in the job market. So why there is this evidence of a slowing economic activity anywhere in the world, but still prices are higher? These are for idiosyncratic features of any economic structure. We don't have to forget that any disruption in supply chains and conflicts like war, they are not by definition, by matter of fact, they are inflationary. Because wars, they are a geopolitical disruption, they are a destructive feature of economic activity. So there is a lot of friction into the system, there is a bidding for raw material, there is a huge constraint in supply chains, and therefore all basic material, raw materials, they tend to increase in prices. So any geopolitical disruption, wherever it comes from, wherever it's generated on planet Earth, it's a cause of exogenous inflationary pressures. So that's why a peaceful world is always better than being in conflict one with another. It's always better to have a dialogue than to have a laugh about something and a lot of self-irony. That will be very interesting. So what do we find is that the rolling, the Phillips curve, it does not have a linear relation which is fixed with within its variables. We see that the level of the Phillips curve, it varies across time. So what I did find out is that the correlation before 2007, 2008, or perhaps immediately after, it was very pronounced, or probably because there was a lot of people unemployed. So the huge plethora of unemployed people, it caused a very strong correlation with the level of prices. Although if you go and check the levels of CPI during 2007 and 2008, you will find out that the level of inflation rate, the headline rate, whether it's CPI or core CPI, they are well above 2%. They are 3-4%. Also in the UK, CPI was way 3, 4, 5%. And that's another feature which is very important to take into account. And I please fix this in your mind, is that whenever there is an inflationary shock into the economy, and this inflationary shock is persistent, because they are persistent. It's not that because they have long variable, forget about the long variable legs. Because inflation, it's not a temporary phenomenon. The level of prices, they are constant. They spread across time, and they go with the business cycle. So once we have a shock in the base level of prices, and the base level of prices go up, they never go down. So this base effect of prices going up, the shift up in prices, it stays there. And so the shock, the level shock, is a persistent feature in the economic function. So what happens is that the economy back in 2007, 2008, it was very healthy. You went into a credit crisis with an inflation rate which was 2-3, more than 2%. So what I'm saying, and it's proof in any data that you're going to find, is that when there is an inflationary shock and it's persistent across time in an economic system, you will find out that inflationary shock into the economy, which very often, and it's strictly coupled with an asset inflation in asset prices, those are the precursor of a financial crisis, which happens thereafter. So we see here that back in 2008, 2009, beginning of 2010, the correlation coefficient of the unemployment gap and CPI was minus 0.62. And that is a strong coefficient because it's larger than 0.5. So it means that the level of unemployment was able to, in an inverse correlation, an inverse linear correlation, was able to explain 62% of price level formation. So it was way more relevant than inflation expectation. Perhaps because there was a shock into the system that was going through. Now, if we go past forward, we see that thereafter the change in monetary policy. So we have the zero lower bound and quantitative easing. So we have a shift into the monetary policy framework. We see how this correlation coefficient after 2015 it becomes positive. So it means that unemployment and inflation, they were moving somewhat together in the same direction. So that it's a flipping of a 180-degree flipping of the Phillips Curve model. Then we see now that after 2016, 2017, we have a normalization somewhat of the Phillips Curve, but the latest parameter we will find with the latest data in 2025, we have a 0.19, let's call it a 0.2. So what that means that now the level of the unemployment gap, so the gap in the labor supply, it explains only 20% of the level of CPI. While instead, back then, more than 10 years ago, with a different economic system, the gap in the unemployment market, also because there was a crisis perhaps, but it's not only because of the financial crisis, the unemployment gap was able to explain 62% of the level of prices. And that's interesting, but what do we find is that the linear, having a linear model of y equals alpha x plus minus beta plus some error factor or uncertainty factor, it does not explain properly this relation. And so many academics, which are probably professors in the United States somewhere, they came up with other models which are not static but they are dynamic. So we assume a set of parameters which reflect an economic system, and then we want to see dynamically. So we have the stochastic component, so the random walk, time derivative component, how these variables evolve across time given certain parameters. And what do we find is that For example, if we use a Bayesian model, so we use a state space model, and so we need some Monte Carlo Markov chain simulations to build all the most probable posterior parameter distribution, so that kind of stuff. We see that we come up to a parameter which is 0.16 or 0.17, which is very close to 0, but nevertheless is the highest parameter that we have when we want to find the k of the Phillips curve. So when we estimate the parameters of the Phillips curve, we have the gamma forward or with the gamma backward, we have the slope parameter and the unemployment gap. Then we find out that with the Bayesian model, using a new Keynesian Phillips curve, we find out that the parameter still is 0.17, which is pretty small, close to 0. And it tells us that even though we use some more complicated macroeconometric model, the flatness of the Phillips curve is a feature of our economic system. Therefore, we can, of course, for sure, we need to do some more grinding of macroeconometrics modeling, and to find out what has happened to the overall economic system and why we keep applying for work, but at the same time, even if we don't have any income, our expectation, they keep building up, and so the cost of living does not abate. Now, in general terms, we know that here, as we can read, we see that, for example, when the slope component, what gives us back? It tells us that for any 1 percentage point increase in the unemployment gap, this will reduce the inflation rate by only 0.05 percentage point. So what that means is that in our post-21st century, post-modern economic framework, it's somewhat ineffective managing aggregate demand. So it's ineffective managing the level of employment or unemployment to achieve price stability, because prices, they are made of a lot of things. They are made of inflation expectations, they are made of cost push factor pass-through, which can be endogenous or exogenous. It can be, level of prices can be determined also by exogenous factor, which I was saying, geopolitical disruption, if there is an energy shock, any of the sort. So only focusing on aggregate demand in our socioeconomic system, which by no means is perfect, it doesn't work. So we can push 1% increase in the unemployment gap, so we can push 1% in unemployment, so we can push unemployment from 4 to 5%. That will not have a material effect on inflation. It will only push the economy into a crisis level. So the unemployment rate. So I have estimated. I think you can see another video that. Let's make some order. So I have estimated that the level of concern of the unemployment rate for the United States economy, it's here. It's 5.5%, 5.6%. What that means, what this implies, is that you will start to see a deterioration in the credit market. So it means that people with ordinary households will start to struggle paying their auto loans, credit cards, so forth and so on. So you will have a constraint in credit. And it doesn't matter if you push down the Fed fund rate, because we will see later in the slides that what is most significant for the cost of borrowing is the corporate rate, or the private sector interest rate, which also explains the level of price formation. Now, so what that means, the unemployment rate in the US is 4.6%. So according to these findings, okay, we can push 1% plus 1% in unemployment. Here we have the unemployment gap, which is the difference between the natural rate of unemployment and the actual level of unemployment. But this will imply of inflation, CPI, going down by 0.05. It's nothing. It's almost zero. The best guesstimate that we can find with the more sophisticated model is this parameter here. So you will have a decrease in CPI by 0.169, 0.17%, thereabouts. Okay, so the models that we have, they tell us that there is a modest but it's a significant trade-off between the unemployment gap, which is not the unemployment rate, and the level of CPI. Now, another example, it's the UK economy, where unemployment it's already 5.2%, but inflation core, it's 3.6%. And this was the unemployment rate in the UK was 4.4%. So the level of unemployment, it has increased by 0.6, 0.8%, but core inflation here, still it's 3.6%. You can go and check the data. It may be not exact by some small margin of 0 point something, but the main concept, the empirical proof, is that you can try to push people unemployed. Inflation, it will not budge. It will not do a thing unless you push the economy into the threshold of crisis level, which means you have a constraint in credit. So when basically you have a constraint in money supply from from banks or the intermediaries of the private sector credit channel, then that becomes a dampening effect of inflation. But it's too late then, because then it means that you are in a rolling recession. So you have created a huge damage that will push up your debt to GDP ratio almost instantly. So managing aggregate demand, it's not the correct thing to do. And policymakers, they know it very well, because they try all the tricks in the world to keep the business cycle going. But the problem is that the private sector, where is banks and investment funds, they push a model which is based on speculation. So you have the economy which is burdened, which has a huge bag to carry through, which is an inflating asset bubble. And of course, at some point, the whole economy, it cannot shoulder anymore this heavy weight of this huge, humongous, overgrown asset bubble. And so you tip over on a side or another, and everything goes down. That's basically how all economic cycles, how they work, more or less. When you push too much to the extremes, a lot of things, then the balance, it breaks down. Now, what do we find when we use three kinds of Phillips curve? We find that in the hybrid New Keynesian Phillips curve as the highest R squared, which is 0.99, but also the other two, they have a good R squared parameter. And we see here that using the hybrid model, we find that inflation expectations, they are 50-50. But in other iteration of the Phillips curve, I found out that for what concerns the US economy, there is this forward-looking parameter which is 0.6 something. So there is a much weight on forward-looking inflation expectations. That's another thing to bring with us. So what do we find? We find that we need more complicated models to understand how the whole economic system works. So when we approach a general equilibrium model, which has a dynamic stochastic component, we find these other parameters which reflect the monetary policy stance of the central banks. Now, of course, these parameters, this 1.01, 1.16, it's important that you know that these parameters, they are injected into the model. So before iterating the model, I have a range that I assign to phi of pi or phi of y of rho, etc. I have a range, and so then when the DSGE model goes through the range of parameters, it assigns the highest likelihood of the most likely parameter, the highest fit statistically, according to the data that you feed into the model. So there is always a range. Okay, what we have here is that, like any central bank, the response to inflation, it's between 1 and 1.16. So what that means is that for every 1% of inflation overshooting the 2% inflation target, you have a restrictive action of the central bank. Another thing here, we have the output gap response is 0, which cannot take it as perfect, this parameter, because 0 it does not convince me very much. So what that means is that irrespective of the business cycle, unless you have a recession, the central bank does not respond to fluctuations in the business cycle. So they look at GDP, but unless there is a recession, they don't hike interest rate when the economy is growing. Tendentially, what it says is that the central banks aims at, like the Federal Reserve, they have two stated aims, which is full employment and price stability. So to measure when the economy it's becoming too hot, they look at the inflation gap. So their response is way more based on phi of pi. That's why we have this estimated range which is larger than 1. Because they have maximum employment, whatever is doing the output gap, the Federal Reserve does not respond in restricting the private credit channel whenever the economy GDP is growing. They don't care. Okay, they don't care. They don't want to put the brakes on a GDP that is growing. They would react eventually if and when there is a negative output gap in GDP, so the economy is slowing, and that would materialize, the negative output gap, it has to materialize into the rate of unemployment rising, as it has been now. In September, like October 2025, the unemployment rate in the United States was 4.1. Now it's 4.6. So you have the unemployment rate which is growing, but the latest GDP data, you have 4.3% real GDP, 3.7% GDP deflated. That means the whole GDP is 8% gangbusters. So they will find it very difficult to cut interest rate, because you have a rate of inflation which is quite healthy, and you have unemployment which is rising, but the business cycle is expanding. So they will not eventually react immediately to the job market. They will rather wait to see where the business cycle is. If they start to see that you have a negative output gap, so that will justify cutting interest rate, because if you have rising unemployment and a negative output gap, that would immediately, almost surely prompt the central bank to adjust the level of the bank rate. But we need to bear in mind that the interest rate that the central bank sets, they are focused on short-term dollar market. What propagates into the economy, which is the monetary policy transmission mechanism, is that what the Fed fund, what becomes in corporate bond rate, in the retail banking sector, what are the level of interest rates that banks offer to their customers, whether they want to buy a house, what is the mortgage rate, which can be 6, 7, 8%, what are the loan rates, credit card rates, so forth, the auto loans, so forth and so on. So what the Federal Reserve does, it's important, but the effectiveness of the central bank nowadays, because we have a quantity of money which is into the system, it's nice to remember to keep in mind the dialectic of the Bank of Japan. So they have a qualitative and quantitative targets or parameters for their monetary policy. So there is quality and quantity, okay? But nevertheless, what are the major constraining factors that the central bank can utilize is basically to constrain the money supply. But that means that the central banks, it has to be way more aggressive, it has to overstep its mark and basically say to private banks, guys, you cannot underwrite private credit so easily because there is too much money supply. The inflation target is going to deviate always, because now it's 30, 40, 50 months that inflation is above 2% in the United States, so inflation is not temporary. Definitely it's not temporary. Right? There are business cycles which go 5, 10, 20, 30 years. They depend on the alpha component, on the Cobb-Douglas function, which is the technology component, how we allocate capital to technology or to labor. And so inflation, it has multi-decade trends. It's not a temporary thing. What the central bank can do is to overstep and say, okay, you need to restrict money supply. But they will not do it because credit depends on money supply. So we get to the raw component, which is the smoothing or inertia. So the central banks tends to wait and see before acting with the interest rate tool. I think that constraining the money supply in the monetary policy transmission mechanism is a way more difficult thing to do, which can be more effective if perhaps you have a digital currency and so somewhat you remove or you constrain the possibility down the line of private banks to issue currency because they need to have the digital authorization from the central banks. Nowadays this does not happen, but that's a technology that it exists. Another DSGE model, which was implemented with BSS, Bayesian State Space Model, which is way more complex thing, it showed that the phi of pi is 1.99. Now this Bayesian DSGE model, it's like a Monte Carlo. You inject into the code how many iteration you want 1,000, 5,000, 10,000, 100,000 draws, and how many simulation you want, and then it shows up with the best fitting parameter. And then we see here, in fact, how the output gap responded 0.4. So what do we see here is that when we inject into our model a probability component, so when we change a little bit the statistical framework, rather than having only a stochastic component, we inject a prior mean and a posterior mean distribution. Okay, so considering the whole sets of data, data a priori that I have, what is the conditional distribution of posterior, which is not a nice thing to say, but I know that I'm crap in explaining. It's basically it's Bayes' theorem. What is the conditional probability that that parameter will be that value? Okay, so having a set of data, which is my a priori assumption, what is the conditional probability that the posterior parameter will be x, y, or z? Okay, so injecting an additional layer of complexity in the general equilibria, which is already a random walk. So it's time derivative stochastic component. We want to measure the probability. So we want to understand, assign certain probability in what will be the most likely parameter that we will get. And so we see here that phi pi it's 1.99. So the reaction to the inflation overshooting it's quantified to be double. So for every 1% of inflation overshoot, we have 2% in hiking interest rate, which it still has to be seen in actual central bank behavior. But we have a 0.4 in the output gap. So there is an alternative policy interpretation are possible. So what it means that there is an alternative, there is another possibility of how the central banks implements its monetary policy for what it concerns the American economy. So when there is a fluctuation in the output gap, the central banks would react some sort of. Now, what do we find? So that as I was saying before, explaining inflation, economic slack, so the slack in the aggregate supply that we measure in the unemployment gap, but then we can see what is the total factor productivity, we can see the short-run aggregate supply, so forth and so on. These are not ideally the best method to have a clearer picture of why we have such level of high prices or such level of very low prices. So the R squared is 0.074, so this is a very low R square, but then what we see is that when we add inflation expectation, R squared becomes 0.73, 0.74. So what that means is that the most important component, this is very fascinating, it's truly interesting. You see here, we do a linear regression, alpha, beta, and the error term. I do make a lot of errors, I'm sorry. And the R square, it comes up 0.074, almost close to 0. So the unemployment gap, it's useless in explaining inflation. As soon as we add an inflation expectation component, we see that the R square, the linear regression, it gives us a very significant R square. But when we add the lagged inflation inertia, we see that the R square goes to 97. So what that means is that inflation, price formation, they are autocorrelating factors. And so that's why we have the new Keynesian Phillips curve, which has a forward and backward looking component in the inflation expectation. So we tend to remember we go into the grocery store and we buy bread, I don't know, salad or burgers, whatever we buy, and we tend to remember prices. And we do a comparison between stores or prices, and we try to understand why prices are changing. And if we find that egg prices are higher than they were 1 month ago, then we start to wonder why this stuff happens. And so in that fits the lagged inflation component, because we have a sort of inertia, and because inflation or prices they are autocorrelated, what that means that when you have a shock into the on the price level, these tend to persist, and so you will see changes across time. So when you have egg prices which go up 10%, they don't go up 10% only once. You will see that they go up 10%, then they go up 5%, because you have a lagged effect which is autocorrelated with the same thing. So because you have an increase of 10%, you can expect, or you will reasonably expect, that the price of that item will continue to go up. It's the same behavior of financial asset prices. If you reflect, is that when the stock price goes up, you expect the stock prices keep going higher. What do you find in the grocery store is that when groceries prices go up, you expect that, or you are scared that grocery prices will keep going higher. And you have a lagged effect on inflation, which is autocorrelated within the same dynamic of prices. And you have an inflation expectation component, which is part of the firm's behavior at the rate of which they adjust prices, which is the Calvo parameter, and the household budget constraint. So how far a household budget can stretch to afford groceries before having to tap into the private credit channel to do shopping. So I hope there is some American who is watching this video, because if you see that egg prices, they keep going higher, you can throw me eggs, I don't mind. Or if you see that meat prices, they keep going higher, they are just like the stock prices. And I believe that the ordinary households, they are scared, they do expect probably that prices keep going higher. It's in the psyche of the ordinary consumer. It's the same as house prices. You expect that house prices, they will keep going high, they will keep inflating. So I will not be surprised if you go into Walmart or in any other corner grocery shop and you expect that prices, maybe they keep going high. Probably not the Italian sandwich grocery shop, because they tend to keep prices steady. But if you go in these big Walmart chains like Walmart or Starbucks, these big corporate chains, I don't know, with I don't know what are the shops in the United States. But anyway, if you go into these big conglomerate shopping malls and you find that prices gone up, probably you expect that by the next shopping season, you expect that prices will be higher. And that it's reflecting that reflects exactly how the stock market behaves. So that's the culture of how the lagged inflation, it's a big component of how price levels or inflation expectation, they may be well above the 2% price stability target. And it doesn't matter what the labor market does. Okay, the consumer, they don't, if I'm a consumer, I have disposable income, I cannot be concerned about people who are looking for work. That's custom behavior, I believe. So what do we find is that there is another thing which is very interesting, and that goes to financial condition. And what jumps to me is this one, is that basically when we do an OLS regression and we see the behavior of we run the OLS regression of the AAA corporate bond rate at the unemployment level, we see that we have a positive component. So if I take a Phillips curve and I run a Phillips curve through an OLS regression, because I don't want to use only the unemployment rate, I want to use a series of different variables to assess what can be another beta component in the Phillips curve, which explains better the level of prices, the output of the equation. So what we find is that the corporate rate and unemployment OLS regression, they have a positive coefficient when it comes to the output of the Phillips curve. So what that means that when there are tighter financial conditions, we have a link which is stronger and the curve is steeper. When we have loose financial condition, we have a flat Phillips curve. And in this case, we are almost able to explain why the correlation of the Phillips curve, this parameter, keeps changing and becomes smaller and smaller and smaller. And that depends when we have loose financial conditions. So when we go back a decade or more and we think of the zero lower bound interest rate and the quantitative easing, or the post-pandemic reaction with the huge fiscal deficits, so you have huge monetary policy reaction, etc., 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 you have very loose financial conditions. And so it doesn't matter, the Phillips curve goes flat. So it doesn't matter what the job market is doing, inflation will behave in its own way and it will follow the business cycle. In fact, the whole dialectic, the whole narrative of a wall of demand because of this or that or the other, it can be true for the first or second quarter, but it does not explain the business cycle. So, because inflation is not temporary. Inflation is not temporary, and the business cycle is not a temporary feature. So it's not a short sugar high of demand that it has been pushing prices higher. There is a whole other plethora of variables, including loose financial conditions. So what do we find, which is very interesting, that it's the corporate rate, and I can assure you that between the list of variables that I used in the OLS regression, there is also the Fed fund rate. But what comes here is that the significant parameter is the corporate bond rate, which is way more linked to the level of employment or unemployment than the Fed fund rate, and it fits into the inflation picture. So tighter financial conditions from the corporate rate of borrowing have a very significant, have a strong correlation with the level prices. So if we have higher unemployment and we have at the same time tighter financial conditions because of the constraint in the private credit sector, then we can see that inflation is high. And that goes back to the financial crisis, or the precursor of the financial crisis. So the warning flashing lights in the economy dashboard is that, as I said, you have an inflationary shock. So the level prices go up. And what happens is that private credit, you start to have some constraint in private credit because you have interest rates which are above 2%, 2.5%. You have some sort of restrictive interest rate. But what happens is that when the critical component is the unemployment rate, when the unemployment rate starts to go to 5.5 to 5 or 5.5%, you start to have higher unemployment. You start to have this dynamic. Higher unemployment and tighter financial condition. Not only because the bank rate, it may be quite constrictive, but you have a tighter financial condition because there is no, you have friction in the private credit channel. So there is no credit flowing into the economy because people are getting unemployment. How are they going to pay back their credit cards? That's the basic thing. So these are the effective dynamic, not these in absolute terms, but these are the features of what happens. Why everything seems hunky-dory, everything is fine, unemployment is okay, but when you are 4.1 and you are 4.6 and you start to go towards 5, it doesn't matter that you cut the Fed fund rate. It matters, but it starts not to matter because the unemployment rate, it creates its own financial friction or private credit constraint on in the money supply. And at the level, you may still have an inflationary shock, or you will start to see that inflation will be below 2% because you have a notable decrease in aggregate demand. But that time, it's way too late. That's the main component. But what I found very fascinating is that the corporate rate is the most significant statistical variable that explains the linear relation of the unemployment gap with inflation. So what we have here is that I had to do a lot of work and I had to use a VAR model. So what do we find is that the federal funds rate, it has an impulse response effect with the unemployment rate, the federal fund rate equation, the unemployment rate, the output gap, and CPI inflation. So of course these are the famous long and variable legs. So when we use a VAR model, we are able to see here 6 months optimal lag, so it's 2 quarters. We see how the equation of the federal fund rate, it has a high significant statistical p-value. So it means that with 2 quarters or 6 months of lag, whenever the central banks does a change in the federal funds rate, This then it has or gives an impulse with the changes in the federal funds rate. Then you have a response in the unemployment rate, the output gap, and CPI inflation. What we see is that when you have a cut in the federal funds rate, you have a decrease in the unemployment rate, or you can have an improvement in the output gap. If you cut the federal funds rate, the likely response of CPI, you will have an upward response in CPI. But usually what does is a bit misleading, because the impulse response function, so here I have CPI, okay, so here we have 0, here we have minus 1 standard deviation, or 1 standard deviation, or it can be in percentages. So we have an impulse from the Fed funds, FF, Fed funds rate, or I will give an F to my video, it doesn't matter. So it's a bit misleading. So if you have a negative shock in the Fed funds, you will see that you can have a temporary negative shock in inflation, but then it does like this. So it means that when the Federal Reserve cuts interest rate, you may have a short-term negative effect on CPI, which can be due to the adjustment of the private sector interest rate, which can be mortgage rate, etc., etc. So you have a negative effect on CPI, but then you have a positive response. So the IRF function, impulse response function, you see that CPI tends to go higher, not that high, but it can be as much as 1 standard deviation up for a cut in interest rate. So it's a bit misleading, but you need to have an eye for these things. So oops. Yeah, we had, okay, no problem. So, at the end of the fanfare, what do we have is that the traditional Phillips curve doesn't work. We need to utilize dynamic, stochastic general equilibrium models, probably even more complicated stuff if we use a Bayesian state space model. So we want to assess the conditional probability of the posterior mean distribution of a set of parameters, and we need also to incorporate the inflation expectation with the new Phillips curve, etc., etc., etc. The most important, not the most important, but the most interesting data that I found is that the corporate rate is a significant statistical factor of whether monetary policy is tighter or it's way more accommodative on top of the Fed fund rate. And the corporate rate, it's a better predictor in statistical terms if we run an OLS regression into a Phillips curve of the behavior, the correlation between the unemployment rate or the unemployment gap and inflation. So because I have some other studies where I do find out that, of course, if we estimate the R star, okay, if we want to estimate the R star, what R star we would like to have, because we can estimate, for example, that R star, the New York Fed R star, it's perhaps here, it's 1 point something, okay, let's call it 1%. The Federal Reserve R star, it will be around here, 1.5, okay. The corporate rate R star, maybe it's 3.5, okay. So the corporate rate R star, starting from here, it's here, okay. So we see, of course, when we use 3 different kinds of interest rate benchmark, we may find that we have different levels of R star. But my initial question is that what is the effective level of interest rate that we need to observe to understand exactly our economic system? Do we really need to observe the central bank interest rate benchmark, or otherwise, when we build our R star model into the DSGE model, we need to incorporate we need to use the private sector interest rate level? And here with this OLS regression, it gives me support on the concept that most probably the corporate borrowing rate, it has a more significant statistical inference with what happens into the economy rather than the central bank interest rate, which is very interesting. Of course, I will not lose my days on R star because it's not that important. Just about because we have so many different level of interest rates. So if a mortgage rate it's for pricing houses, a auto loan rate it's for houses, credit cards, I don't know, business. So if I have a corporate bond or I have a some sort of private credit, private equity, business senior mezzanine loan or senior or junior mezzanine, or that sort of stuff. So there is a whole universe of interest rate benchmarks at which the economy functions. So that's why my initial assumption is that if we take only the central bank interest rate, we would not have a clear idea of why this, that, and the other happens into the economy. But we need to get to something more real, which is not distant. So it's perhaps corporate bond rates, so forth and so on. So that's the most interesting thing that I found out. And well, I think we can wrap it up for today. I have also some other very interesting slides which are pretty much on the same argument. And okay, so if we take a 20 years sets of data, we want to have an interpolation between all these variables, and we use our models, then we find here simple Phillips curve. So of course that's very, very interesting, but in the end the Phillips curve, the simplest model, it's quite a simple equation. Now we'll give you a couple of things, but I think it's way better if you go and Google it. So the ordinary Phillips curve. So we want to know what is inflation at time t. So we have the alpha component and the slope, the beta component, mu of t. Then we have, when we inject the inflation expectation into the Phillips curve, which is the Friedman-Phelps Phillips curve, we want to know pi of t inflation at time t, but we have inflation expectations minus the beta component, and we want to have the unemployment gap here, okay, which is this one. We have CPI year on year on percentages term, so we have some sort of CPI level or inflation expectation minus beta, which is the slope of our regression, the beta parameter, and then we just get there the unemployment gap. But if we use a OLS regression, and with the unemployment gap we inject the corporate rate level, corporate borrowing rate level, we have a way more significant Phillips curve model. So that's the more or less the mathematical dynamic that comes up. So then a new Keynesian Phillips curve, for those who say, oh, the new Keynesian economics is it's just don't listen to them. Subscribe to Economica, it's way better. So the new Keynesian Phillips curve is pi of t. So we have our beta component, our expectation component of the probably the Euler equation. So we have our pi of t plus 1, so the expectation of inflation at time t plus 1, plus a k, which is the slope parameter, which is the same of beta, now we call it k, from x of t, which is the output gap or the marginal cost of employment, which is the total factor productivity minus the wage level or something like that. I may be wrong, but you can see how the difference is here, which is interesting, how we can measure the same thing just flipping around stuff, because here we have the beta component, which is the slope, but we have the gap into the unemployment level. Okay, here the new Keynesian model, so the academics thought very well to change it a bit and say, okay, we want the K, but instead of using the unemployment gap, we use here X of T, which is an output gap. So we want to measure inflation expectation and the slope vis-a-vis the aggregate level of output of the economy, and that will give you, of course, a different parameter. So there are many ways in which we can observe inflation. So we see the same thing, that the simple Phillips curve level, it does not, simple Phillips curve method of estimation, it has an R square which is almost close to 0. So what that means is that the simple Phillips curve, it does not help us because we have a rolling factor, also behavioral changes in the economy. Wait a minute, that comes up. Where is the rolling? Okay, we have a rolling correlation of the Phillips curve correlation coefficient. So a static model does not help us. So with a simple model, you see that also the Taylor rule, it has a phi of pi parameter, so the inflation response is 0.27, which is very, very low. And also the R star, the natural rate, is also very low. And that it's not really the Taylor principle is not satisfied, because this parameter, it should be always greater than 1. For the simple fact, if I have 1% inflation overshoot, I will jack up interest rate more than 1% by a factor of 1.25, 1.5. What is the more ideal stuff to do? So we have to introduce more dynamic things. So we start to use a VAR model. So we start to see what is the impulse response function. We use the Granger causality model. Also the Granger the Granger causality, or the Granger causality formula, was also a theoretical component factor of the DSGE model, of the dynamic general equilibrium model, because with the Granger causality we are able to see, okay, considering that this variable, the federal funds rate, has behaved in the past in this manner, and almost certainly I have a response which is statistically significant from this other variable. So when I have asserted certain Granger causalities, which are typical in any economic system, then I can inject this mathematical framework into a broader twin model of the economy, which is the dynamic stochastic general equilibrium model. So as we saw in the other VAR model, this is a different one, is that when the federal funds rate moves, you have change in unemployment, the output gap, and inflation. Of course, that's what happens. Then we can see here how we evolve into the DSGE diagram model. So here we have the famous beta factor that I was saying, like the UK household, they are not so patient. They do not value consuming tomorrow as much as consuming today. So they are not very patient households. So here this discount factor, which it's within a certain range, it's a preset range. It says that household data of the United States consumer tells us that the households are pretty much patient, so they have a high discount factor, so they discount the value of the dollar today or the value of the dollar tomorrow pretty much is almost equal, like 98 cents or 99 cents of a $1 today. So they value food consumption, and they have moderate risk aversion. And again, we see that this time around it's not the beta, it's the K component of the new Keynesian Phillips curve slope. It's 0 point something, so it's very flat. So there is no trade-off between the output gap, in this case not the unemployment gap, the output gap and the level of prices. We see the Taylor rule principle is satisfied because we have a parameter higher than 1 for the monetary policy response function, and we have a certain inertia or smoothing of the monetary policy transmission mechanism. So what drives inflation? So decomposing the new Keynesian Phillips curve, we see here that the hybrid Phillips curve is the most statistically significant. What that means is that we need to have the gamma F and the gamma B, which is the forward and backward-looking components or parameters which incorporate some sort of consumer behavior, nevertheless. And we see that here they are 0.5, but I have other models where the gamma of F it's 0.6 or larger, so there is a much more weight on the forward-looking component or the inflation expectations, which I think it's more appropriate for American households. And also we see when we have estimate the decay parameter, so the slope of the Phillips curve, we see how it varies across time. So we have a dynamic change of the Phillips curve in terms also of the output gap, because we have the fluctuation of the output gap and or the real business cycle. And we see how we have at 0 point the median and the standard deviation, they are pretty almost the same, which is 0.12, 0.13. So there is an equal average value and standard deviation of the slope component for what concerns the output gap. And the range is quite large. And we see here the slope of the Phillips curve, it's highly unstable. So what that means that, okay, yeah, the standard deviation is nearly as, what I was saying, is nearly as large as the average value. And this very challenges the reliability of the static Phillips curve model. So it's nice to see the thing on the slides. And okay, so we see again the same thing, that we have again the same model, the Bayesian component. In this case, we have a different thing, which is again way more complicated, but it's probably worthwhile to have a thought about that. So as we see here, we have a Minnesota prior, Metropolis Hastings Markov chain Monte Carlo Bayesian VAR model. So what that means is that when we hear about the monetary policy, it has this long and variable lags. So whenever we would like to shrink the error variance or the volatility component or the lag component in our VAR model, so whenever we want to shrink the lag component when we have a VAR model, so when we try to see, for example, as we saw before, whenever the central banks change the Fed funds rate, we have a response in unemployment, output gap, and CPI. Whenever we want to narrow down the error that we can find with the lag component into the model, we can use a Minnesota prior feature, and we implement this very complicated stuff, which I have lost my words for, which is Bayesian VAR, and we can find out the same parameters, we can estimate the same parameters, or else what is the phi of pi, so what is the inflation response of the central banks, and we see that we have a very reasonable parameter 1.16. The K or the slope of the Phillips curve still results to be pretty much flat, but we have discovered that the slope of the Phillips curve, it has a way higher statistical significance when we utilize the corporate rate. Then we have the rho component, the policy inertia, and here we have the gamma forward and gamma backward. We see how the gamma forward, it has much a larger weight of inflation expectations or the slope of the Phillips curve compared to the backward component. So when, in a sense, when we try to eliminate the error noise of the lags in a VAR model, with the Minnesota prior and the metropolis asking, oh, that complicated things. When we try to eliminate the error noise of a lag of the impulse response function, we see how the forward component of in the New Keynesian Phillips curve, it has larger weight in assessing the level of inflation, or in predicting the level of inflation. So it confirms that inflation is primarily forward-looking, but with a meaningful backward-looking component. So what we see here that eventually inflation expectations are more based on future forward-looking inflation expectation. So this